this video, we will see how to calculate fair value of a future. We can see different types of traders. See, day traders, swing traders, long-term traders, fundamental traders. Some trade based on their intuitions. Intuitions means how they feel like. So we call them as novice traders who are very new to the trading. And some follow technical analysis. They are technical traders. So that is technical trading. Whatever a successful trading is always based on knowledge, experience, skill, and how we practice the control of our emotion. And most of us trade without knowing future pricing formula, which may not be required if we are using technical analysis, but at least a bit of understanding about the future pricing formula is always better. That's gaining knowledge. If you have seen my earlier videos on futures, that basics of futures, more about futures, we had talked about the difference in spot and future price, right? So we know that the future mimic the spot. See here we can see Nifty April future and Nifty 50. This is the spot. See both of them 23rd, okay, 23rd April. Both of them, they're almost same. Okay, here and there little bit differences there you can make out. Okay, this graph and this graph, they mimic each other. We can open the spot graph and trade the future, right? You can open this spot graph and trade the future. But as I explained in earlier videos, their figures will be different. The prices will be different. The difference between future and spot price is called basis, okay, or spread. You must have heard about the terms like cost of carry, cost to carry, spot future parity. All are related to this basis. This difference depend upon several factors, okay, like interest rates, dividends, expiry time, etc. Let's see how future pricing formula works. Okay, it is for knowledge to know whether a future is under or overpriced. That is also more important. Okay, this is future pricing formula. Okay, this gives a fair value of a future. We call it as fair value. Okay, so we are calculating on our own and without taking the factors like interest rate, dividends, all those and few other factors. So here future price equal to spot price multiplied by 1 plus RF is risk-free rate, that's earned for the entire year, multiplied by A. A is number of days to expiry. If we are taking current month contract, say another 15 days is there, so this A will become 15. Or if you are taking the next month 30 plus 15, whatever the days, from that Thursday which it's going to expire, you need to calculate from there. Divided by 365. That's for entire the 1 year. 1 year. Okay, 365 minus D. D is dividend. Okay, dividend. Usually the companies declare dividend at the year end or quarter end, right? So we have to minus that. So future price will be minus of dividend also. So this is called a fair value of future. So when actually we calculate, we get the difference again between fair future price and the market future price. So this again depend on market cost like year-end dividends, tax, transaction charges. So we call it as cost of carry also. Okay, as we know, like if one wants physical delivery in commodities, like they can buy the future of the commodity, okay, now and take the delivery on the expiry day, right? So you don't have to, you have to pay the cost of carry for that. For so many days, they will be holding the commodity for you, right? So it's a that kind of the term is cost of carry. So in the formula, we can see which factors are directly proportional and which are indirectly proportional. So depending on that, you can make out. If dividend is there, we can say the uh, price will be less because we will do minus D, right? So if future price is less than the spot price due to demand and supply imbalance, sometimes it happens. So future is cheaper than the spot. We call this as future is at discount. Okay, so because future is less than the spot. So other way, if a future is more than the spot, okay, this usually happens. So we call it as premium. Future price is at premium. So people make use of this fact and transact in different markets, which is called arbitrage trading. Okay, you must have heard about arbitrage trading. Okay, so this strategy gives a guaranteed income. See, you will be locked with the points whatever you are doing in this. Okay, and this strategy gives since it gives guaranteed income, so we don't have to worry much, but it will be very less the points. When I had tried this arbitrage trading, I didn't get many points. Then if like future is at discount, so what we have to do, if future is at discount means future price is less than the spot, so buy in the future market and sell the spot in the equity market. That's like different markets, right? Future market and equity market. It's like hedging, but it's in the different markets. So we will be, whatever the difference points are there will be blocked. Those points will be blocked for the profit at the end of the expiry. Okay, so and if we are doing it in futures only, okay, hedging futures mm, like if we are doing say Nifty only, so Nifty near month and for month. So here it happens, the hedging happens, right? So your premium uh, will be reduced because of the hedging. But if you are doing in the different markets, it will not be reduced, but it will be like a hedge only. So in our formula, the future pricing formula, we have seen the risk-free rate, right? So in the risk-free rate, what we can do is we can take it as a proxy from RBI's treasury bill for 91 or 182 days. For risk-free rate, I have gone to Reserve Bank of India website and have taken the value from 91-day treasury bill primary yield for April. See April, you can see the latest one. It's 3.35. I have used this one in the example. So in this example, I have taken spot value as 14,450 and expiry days remaining is 6 days. So the fair value formula, it's D5 is the spot multiplied by 1 plus, this is the risk-free rate 3.35 which we have taken from the RBI's website, multiplied by D3. D3 is expiry days divided by 365 minus 0. So I have not taken any other factors, dividends or the cost of carry factors into the account. So the value will be little bit high only, the fair value. So it has come this much. Okay, but this actually differs. Okay, this is the example.